Welcome to the video lecture for Chapter 3, the accounting cycle. In this chapter, we're going to just kind of recap the basic accounting cycle and the system, the accounting information system, and how we, the process from between journal entries all the way through to the financial statements. Let's get going on this. Generally, there's two portions of this chapter. There's the accounting information system, the basic terminology. What is a debit, what's a credit, the basic equation, assets equals liabilities plus stockholders' equity. We'll talk about that in just a second. And then what are the financial statements and the ownership structure of a company. And then we're going to talk about the accounting cycle. The accounting cycle is the whole process between journalizing, recording entries in the general journal, all the way through to preparing financial statements and closing accounts out and post-closing trial balance and getting ready for the next year. So we're going to go through the whole process. Hopefully this brings back a lot of memories, and hopefully it's a good basis of accounting knowledge to work off of in our subsequent chapters. So this is our basic accounting system and accounting cycle chapter. So if you remember the basic accounting equation, it's just that assets equal liabilities plus shareholders' equity or stockholders' equity. So this is it always has to balance. Your assets have to equal liabilities plus stockholders' equity. The other thing to keep in mind is that for every debit, we need to have an offsetting credit. So the way these are related is that assets typically have debit balances, so debits will increase assets and credits will decrease assets, and liabilities will typically have credit balances. So credits will increase liabilities and debits will decrease liabilities. So that's the general way where they're related. So again, if you have a negative value in liabilities or stockholders' equity, it's going to be opposite. So a negative value like dividends or expenses will be increased by debiting it and decreased by crediting it. But in general, that's how these two sides of the balance sheet are related. There's not really a definition for debit being good or credit being bad. It's just how these things are set up. It's kind of abstract here, so you got to get this down. One of these tricks that I have for kind of remembering debits and credits is DLOR, just a mnemonic thing. Debits increase dividends, expenses, and assets. Credits increase liabilities, owner's equity, and revenue. So hopefully that helps. Maybe, I don't know. But this is really important. If you're not getting your debits and credits right, this class is going to be tough. So make sure you're able to do that. Once we have debits and credits down, then we need to think about this accounting cycle. We have these transactions that occur between us and an outside entity, our entity, an outside entity. We have to record those. We record them through journalization. So we do a journal entry, record it in the general journal. Those general journal entries are posted to a general ledger, which summarizes all of the accounts. You'd think of the general ledger as the T accounts, right? You're posting your journals to the T accounts. And then based on all of those account values, we're going to create a trial balance. We're going to adjust that trial balance for accrual accounting. So we'll talk about the 4 types of adjustments we might make. We'll have an adjusted trial balance, and then we'll have the financial statements. And then there's these last few things, closing entries. So the temporary accounts or nominal accounts need to be closed out and ready for the next year. So income statement accounts. And then we'll have a post-closing trial balance. And then if we have to, we'll have reversing entries. We won't talk too much about reversing entries. That's in the appendix to your book. But this is sort of the accounting cycle. So we'll talk about that in more detail in a second. First thing is, what do we record in financial statements? So at the beginning here, we said we had transactions that we want to record with journal entries. So what do we record? What kind of transactions or events do we want to record? Well, we want to record anything that could affect the value of a business and enterprise. So the FASB says transactions and other events are circumstances that affect the business enterprise. We want to, and which ones do we record? Well, we record everything that can affect the value of the business that we can actually measure, right? So types of events, there could be external events, events between the business and its environment, or there could be internal events, events occurring entirely within the business. A transaction is a type of external event because it's between your business and outside business. So if I'm at Starbucks, they sell me a coffee, that's a transaction with an outside entity. It's an external event, a transaction with a customer. All right, so that's kind of the basic terminology there. Journalizing. Journalizing is recording entries in the general journal entries. It's the general journal is a chronological record of transactions, and journal entries are recorded in the journal. So in this case, we see that there's a credit to common stock and a debit to cash. What could that be? Well, it's probably an investor buying some stock in the company. So they've invested $100,000, and in exchange they get $100,000 worth of common stock. Again, cash is an asset, so by debiting it, we're increasing the cash balance, and by crediting common stock, we're increasing the equity account. All right. And since common stock is an equity balance, we want to increase that too. This other one, building, right? We're likely buying a building with a note payable here. So again, building's an asset. We're recording the building at $150,000, and we're paying for it with a note payable, which is like a loan, right? So that's basics. Hopefully some of this comes back to you. Sometimes there's these reference letters or numbers. If you're in the real world, right there, most of these accounts are going to be recorded by reference numbers because there's going to be a million different cash accounts. So at a company like General Electric, they have tons of different cash accounts. Each of them has a different reference, and you want to be able to keep them straight. So there's usually numbers to record them. But for purposes of this class, we're not going to really play around with these reference letter numbers. Just keep that in mind in the real world. All these accounts typically have reference numbers or identifiers. All right, so the next step is posting. So after we get these journal entries, cash, common stock, someone bought some common stock and from our company, and we recorded cash and common stock. Well, we have to record we want to keep track of the balance of each of these accounts, right? We want to keep track of cash. We don't just want to have the journal entry. We want to keep a track of what the balance of cash is. Well, we're going to use the journal ledger to do that. So with cash, we're going to record the sale of stock here as a debit. So we're going to keep track of debits and credits. Again, this could be done with a T account, right? With debits on the left-hand side and credits on the right-hand side. So this is the sale of stock. We could record an explanation. We could refer back to the journal entry so we know which journal entry we're talking about. Here's JG1. We're able to connect these two. We have an area where we're recording entries, the general journal, and then we have an area where we're keeping track of the value of each account, the general ledger. All right. So then we have a trial balance after we go through this process, and let's say we have tons of journal entries, and they're all being recorded in the journal ledger. They're all being recorded in the journal, and then being summarized in the general ledger. Cash is going to end up with an ending balance. That ending balance is going to end up on the trial balance. So eventually, the ending result of the general ledger is final balance in the cash account. That final balance is going to end up in the trial balance. Again, remember, there's always debits and credits here. And based on the value, the ending balance of every account, we put together a trial balance. Again, the trial balance should balance debits and credits. That's always nice about accounting. You can there's at least one check here to make sure you didn't screw something up. There's Debits have to equal credits. 385,000 equals 385,000. And then we feel pretty good about what's here. A note to you guys, even if these two balance, if 385 equals 385, there could be a problem, right? You could have entered the wrong amount for a debit or a credit, and even though they balance, it doesn't necessarily guarantee that you have the right answer, but at least it's one thing that you can look for. All right, so trial balance. The next step in the process is booking adjusting entries. So we're going to spend most of our class today on adjusting entries. Adjusting entries are entries made to ensure that we are recording things in accordance with accrual accounting. So revenues are recorded in the period in which they're earned, not when cash is paid, right? Or in the words of the new revenue recognition standard, revenues are recorded in the period in which performance obligations are met. On the other hand, expenses are recognized in the period in which they're incurred, and they're matched to the timing of revenues. Again, we want to make sure that these general principles are followed in our financial statements. So the way we do this is we make adjusting entries at the end of the year, at the end of the reporting period, to ensure that we're following accrual accounting. What we're doing is we're going to follow the revenue recognition principles and the matching principle. And so these are the four typical types of them. There's prepayments or deferrals, and there's accruals. So in some cases, these are instances when cash and expenses or cash and revenue don't line up. So prepaid expenses are when we might have expenses that are paid in cash before we actually incur the expense. So expenses are paid in cash, and we record them as an asset before they're used or consumed. So that's the first type. There's unearned revenue, where we have revenue that's received in cash and recorded as a liability before it's actually earned. So that's unearned revenue. So we call these two categories deferrals or prepayments. It's when cash exchanges hands before revenues earned or expenses are incurred. On the other hand, there's accruals. Accrued revenues are revenues earned but not yet received in cash or recorded. And there's accrued expenses, which are expenses incurred but not yet paid in cash or recorded. So in these cases, we've earned revenue or incurred expenses before cash is received or paid. Okay, so these are the four main types. We'll go through each of them in detail here. So again, prepaid expenses are when you have cash payment before an expense is recorded. A lot of times this happens with insurance. You'll pay for insurance before you use it, right? If you have car insurance, you buy car insurance at the beginning of the month rather than the end of the month. It wouldn't work very well if you bought it at the end of the month. Because you probably only pay for it if you had a car accident. So, insurance is a good example. Supplies, you buy supplies for your business. You buy them before you use them. Advertising, a lot of times you pay for advertising up front and then they provide the advertising. Rent's going to come up with all of these. I think rent is usually a prepaid expense. So if you guys are all paying rent, to stay in your apartments or wherever you're staying, you pay that up front usually, and then you get your month's worth of rent, place to stay for a month, or however long you're prepaying it. Maintenance on equipment and fixed assets. So one of the ones that you might not think about here with prepaid expenses is like depreciation. So if you buy a building, for example, Cranert or any of these buildings that are around Purdue, you're paying for that up front and you're depreciating it over time. So you have cash payment before expense is recorded. So depreciation expense is the expense that you record as the building falls apart over time, right? As it becomes worth less over time. But this is a prepaid expense if you think about property, plant, and equipment. Those are prepaid expenses. So that's one you might not think of immediately as one of these adjusting entries, but it is. So that's a prepaid expense. Here's an example. On January 1st, Phoenix Corp pays $12,000 for 12 months of insurance. Show the journal entry to record the payment on January 1st. So on January 1st, we're just going to record the prepaid insurance as an asset for $12,000. So it's going to appear as an asset on our balance sheet of $12,000. We paid for it up front, but we haven't actually we haven't used the insurance coverage. The insurance coverage is going to be valuable for 12 months. So just something to keep in mind, this is not the adjusting entry. This is just the entry that we record when we pay this cash. The adjusting entry is going to come at the end of the year after we have incurred some of this expense. So at the end of the reporting period, we've incurred some of this expense. So in this example, we have an adjusting entry on January 31st. So on January 31st, a month has gone by since we bought this insurance coverage. So we've used a month's worth of this insurance. So we can record $1,000, which is equivalent to one month's worth of this $12,000 prepaid insurance policy. So $12,000 here divided by 12 months will give us $1,000, 1 month of insurance company. We'll record the expense for that 1 month using 1 month of that prepaid insurance, and we'll reduce our prepaid insurance by 1 month's worth of value. So what's left over in insurance expense, prepaid insurance, is going to be $11,000. So that's good for 11 more months, but we've recorded the 1 month's worth of insurance expense. All right. So again, just remember, we have a debit for expense. Expenses increase with debits because they decrease our equity, they decrease income, which are credit balances. All right, so that's our prepaid expenses adjusting entry example. The next type of adjusting entries we'll talk about is accrued expenses. Again, these are expenses incurred but not yet paid in cash or recorded. These are, again, another example is rent. So you could potentially pay rent at the end of the month. If we pay rent at the end of the month, we're going to have expense for rent before we have any cash payment. That doesn't typically happen. Usually prepay rent, but you potentially could pay rent at the end of the year, end of the month. Interest is a really common example. So if you're borrowing money, you're going to incur interest on those borrowings. That interest is going to build up and up, and then you're going to pay that later. So you're recording interest expense before you have any cash payment. So your student loan, if you guys have student loans, those student loans are accruing interest, and again, it's an accrued expense, not a deferred expense. It's an accrued expense. All right. So taxes, another big one. Throughout the year, you accrue taxes, and you don't pay the taxes on December 31st. You pay the taxes when you file your taxes. Salaries, again, you may not pay your salaried employees at December 31st. If you don't pay them at the end of the year, at the date of the financial statements, they'll probably have worked for you and not been paid yet, and that's going to have to be recorded as an accrued expense. And then finally, bad debts. Bad debts is kind of an interesting one, right? So you're going to accrue for bad debts beforehand. So I don't know if you guys remember, but the allowance for doubtful accounts that you book, we'll talk about this in more detail too when we get to, I think it's the next chapter. But when you have accounts receivable, you have to estimate the amount of bad debts you're going to have. How much of that accounts receivable will not be collected? Well, when you estimate the bad debts, you record expenses, and this is before but this is an expense. This is an accrued expense, so we're accruing this expense for these uncollectible accounts. But in fact, you don't have any cash payment at the end of it. It's the lack of a cash payment. So that's why this is, if any, asterisk thing. So it's you're recording an expense before not receiving a cash payment, the absence of a cash payment. So, but that's also considered an accrued expense. So anyway, things to keep in mind. All right, so here we have Phoenix Corp again. February 2nd, they borrow $200,000 at a rate of 9% per year. This is an accrued interest example. Interest is due at the first of each month. Show the journal entry to record the borrowing on February 2nd. So on February 2nd, we borrow $200,000. We debit cash to increase that asset to $200,000. And we credit note payable to increase that liability to $200,000. All right, so we have a liability of $200,000. We have cash of $200,000. We're going to have to pay 9% interest per year. So we make an adjusting journal entry. We might not have paid the interest yet. Interest is due on the first of each month. It says, show the adjusting journal entry on February 28th. So we haven't yet paid the interest, but we want to post our financial statements. We want to put together our financial statements. So we need to adjust our interest expense. We need an adjusting entry for this interest expense that we've accrued on this bank loan. So $200,000 at 9% per year is going to end up giving you $18,000 worth of interest. So then we need to divide that by 12 months because only 1 month has gone by. So this is February 2nd through February 28th. Only 1 month has gone by. If it was an entire year, this is usually something to keep in mind for all of your problems in this class. Interest rates are typically reported as an annual interest rate. So you should always go under that assumption that you have an annual interest rate. So 9% annual interest rate, again, it also says per year. So but if the per year wasn't there, you should always assume interest rates are annual interest rates unless they say otherwise. The annual interest expense is $18,000, but since only 1 month has gone by, we're going to divide that by 12 to get $1,500 of interest for February. So we're going to record interest expense related to that 1 month's worth of interest of $1,500, and we're going to have an interest payable of $1,500. So we know we're going to have to pay this interest in the future. We record the interest expense, and we have interest payable of $1,500. All right. So on January or March 1st, we're actually going to pay this interest. Right? It says that interest is due on 1st of each month. If we pay this on January 1st or on March 1st, we're going to have what? We're going to have a debit to interest payable and a credit to cash when we pay it. So we're going to pay cash out and reduce the interest payable down to 0. Okay. All right, so that's accrued expenses. The next one is unearned revenues. Unearned revenues are where we receive cash that's been recorded as a liability and recorded as a liability because we have not yet earned the revenue associated with that cash. So someone else is prepaying us, right? We're a magazine company. I guess that's the one we have here as an example. Magazine company, and all your customers are prepaying you, and now you have to provide that magazine for an entire year. So we can't record the revenue immediately just because we've received the cash. We actually have to do something to earn that revenue. So again, rent could also be from the rent's always great on all these, right? If you're a landlord and you receive rent prepaid, you have unearned revenues. You have to provide the place for people to stay for that month. Airline tickets are a great example. All the airline companies, everybody prepays for an airline ticket. So all the airline companies, United, Southwest, they all get paid ahead of time and then have to provide the flights. So they have tons of unearned revenue. School tuition here at Purdue, right? You pay your tuition up front. Purdue records as an unearned revenue, and then as the year goes by, they earn that revenue. Customer deposits, it's, if you end up buying something, paying for something ahead of time, then I think that right now there's a few companies that do, for example, if you wanted something custom made, like shoes or something, you might pay up front, and then they put them together for you, and then you get them at the end of when they're done, right? Customer deposits. Season pass for a ski resort or something like that, you pay up front, and then they provide the ski resort for the whole year. So all these things are unearned revenue. Here's an example. Phoenix Corp receives $24,000 from Arcadia High School for 3 months rent in advance. This is a rent problem. Phoenix Corp would be a landlord, for example. And should the journal entry to record the receipt of cash, again, record the cash as $24,000. Unearned rent revenue, what is that? Asset or a liability? It's a liability, right? It's a liability. We have to earn this rent revenue. So we're going to record that liability. In the future, so unearned revenue is always a liability. In the future, we're going to earn that rent, and we can record it as revenue and reduce this liability. All right, so here's the adjusting journal entry. We had 3 months rent in advance, $24,000. 24 divided by 3 is going to give you this $8,000 of revenue that we earn after 1 month has passed. So November 1st is when we entered into this contract. November 30th, 1 month has passed, so we record 1 month's worth of rental revenue and reduce our earned rent revenue liability. So now what's left over is $16,000 in unearned rent revenue. That's for the remaining 2 months of rent that we have to earn. And we actually recognize $8,000 worth of that rental revenue. All right, so that's unearned revenues. And then the last adjusting entry type that we cover is accrued revenues. Accrued revenues are when revenue is recorded before cash receipt. So we have revenue, but we haven't yet received any cash for it. So what's a really obvious example of this? Well, it's like accounts receivable, right? Rent, you could have rent receivable, you could have interest receivable, or accounts receivable. This one I'm sure you've seen before. You do something, but you just haven't been paid yet. And this is very common. So in this case, though, we have Phoenix Corp. They're investing $300,000 in securities that returns 5% interest per year. Show the journal entry to record the investment. So here's a little bit different situation. Usually you've probably seen where you do work for somebody, you've earned some revenue, but you haven't been paid, and so you'd record an accounts receivable. You'd record revenue in accounts receivable. In this case, I've lent $300,000. I've given somebody $300,000 in securities that return 5% interest per year. We want to accrue for the interest revenue that we're going to earn on these securities. So the initial journal entry is just to buy the investments for $300,000. We have cash of $300,000. This is not the adjusting entry again. These are all just setups. So now we have the investment, and we decreased our cash balance. We increased our investment balance. Then at the end of the month, July 31st, we're going to have these securities are going to return 5% per year. 1 month of that 5% interest is what we want to record as interest revenue on July 31st. So $300,000 times 5% would be $15,000. That's the annual interest revenue. We divide that by 12 months, we should be earning $1,250 per month from this investment. So July 31st, our interest receivable is $1,250, and our interest revenue is $1,250. So with accrued revenues, you're going to record receivables usually. when you record that revenue. All right. And so we have, again, just to remember the process, we journalize, and then we post those journal entries to the general ledger. This is the general ledger. Okay. So now we've gotten through journalization, posting to the general ledger, the trial balance. We've talked about that a little bit. The adjustments to the trial balance, and then the adjusted trial balance is the next piece of it. The adjusted trial balance shows the balance of all accounts after our adjusting entries at the end of the accounting period. So again, we did journalization. Those are day-to-day transactions are recorded in the general journal. We post the general journal to the general ledger. We record all the account balances in the trial balance. Then we have adjustments to the trial balance. Those are adjusting entries we just talked about. And then we have an adjusted trial balance, which is what we're putting together right now. And from that, we can create financial statements. Okay? So preparing the financial statements is the next step. They're prepared directly from the adjusted trial balance. It's the balance of all our accounts after our adjusting entries. We can create a balance sheet, an income statement, a statement of retained earnings, and a statement of cash flows. We'll get into more detail about each of these separate financial statements in the subsequent chapters before this first test. But right now, we're going to do just a quick move going from the adjusted trial balance to these financial statements. So here's our adjusted trial balance now. And we want to create a balance sheet, an income statement, and a statement of retained earnings. So the biggest thing to know when we want to go from adjusted trial balance to these financial statements is what these accounts are. So you need to know which accounts are asset accounts, which accounts are liability accounts, which accounts are equity accounts, which accounts are revenues, which accounts are expenses. So that's going to be really important. So this chapter, part of it's going to be remembering what all these accounts are, what they actually relate to. So if you took these first few, cash, right, is an asset account, accounts receivable is an asset, the building is an asset, a note payable is a liability, common stock is a component of equity, retained earnings is a component of the statement of retained earnings, but eventually equity. And then we'll talk about the rest of these. But the first few, again, are just assets and liabilities. With equity, equity is made up both of retained earnings and some permanent accounts in equity, common stock. And also, we have updates to retained earnings based on our net income, our changes in financial position. So that's going to be summarized in your statement of retained earnings. So in our balance sheet, we're going to have all the assets, liabilities, common stock, which is again a permanent account and stockholders' equity, and then retained earnings. Retained earnings is going to consist of both beginning retained earnings, which is here, and any changes to retained earnings, which are going to include dividends declared, and then your income statement items, which are these ones: sales, interest income, cost of goods sold, salaries expense, and depreciation expense. This is your income statement. So sales are revenues, interest income is revenue, cost of goods sold is an expense, salary expense is an expense, depreciation expense is an expense. So again, retained earnings, beginning retained earnings minus dividends declared plus net income. Net income consists of sales, all these revenue and expense accounts. So here's your income statement. Sales, interest income, those are types of revenue. Expenses are cost of goods sold, salaries expense, and depreciation expense. Net income of $87,000. Your statement of retained earnings, like I was saying, you have this beginning balance of $38,000. You had net income of $87,000. You paid dividends of $10,000. and so you had an ending balance of 115,000. That 115,000 shows up here on your balance sheet as a component of stockholders' equity. All right, so just a quick note here on temporary and permanent accounts. Permanent accounts are recorded in your balance sheet. Temporary accounts are closed out. So these temporary accounts are also called nominal accounts. They're closed out to retained earnings. They're like income statement accounts. So these are all temporary accounts in the income statement. And they're closed out. This $87,000 is closed out to retained earnings, our permanent account or real account. Okay, so these are that's how we're going to prepare our financial statements. And after we've prepared our financial statements, we're going to have closing entries. So now that what I was talking about before, we had these temporary accounts, like revenue and expense. We have to close out and return to zero for the new year. So like we talked about last class, the income statement records data over a period of time, whereas the balance sheet records it at a point in time. So we need to start over with an income statement at zero. And so, 2020 is over. 2021, we have to start over again and start recording revenue and expense for 2021. And we have to start over at zero. So how do we get revenue and expense back to zero? Well, we have to close all the accounts out and transfer net income or net loss to owner's equity via retained earnings. The balance sheet accounts are permanent accounts, so they're not closed. Those are real accounts, permanent accounts. They will collect the data, collect the changes in financial position that were recorded in the income statement, and they'll stay there. Dividends are closed directly to the retained earnings account. So we're going to close net income and retained earnings, or net income and dividends out to the retained earnings account. So I'll show you how you do this. Again, it's just a journal entry, pretty quick journal entry. The closing journal entry here is going to just close out all these dividends and everything that's part of net income. We're going to close it all out to retained earnings. So this can be two parts, with the income accounts first and then the dividends account, or you can do it all at once. I think I prefer doing all of the income statement accounts first and then doing the dividend account to retained earnings so that you can keep track of net income. Okay, so here we go. Which accounts need to be closed? Again, balances should be zero, so we close these to an income summary if you want with the income statement accounts. And then we'll close dividends declared directly to retained earnings. Okay, so here's the journal entry. Sales, interest income are debited because they had credit balances, right? And cost of goods sold, salary expense, and depreciation expense are going to be credited because they had debit balances. We want those balances to be zero, right? And the balance here is going to be debits minus credits, so we want that to be zero. So again, by debiting sales for $185,000, it offsets the credit balance of $185,000 here in sales. So it ends up being zero. All right, so we take care of the revenues, then we take care of the expenses here. Close them both to income summary. If you close them both to income summary, this is just sort of an account that you can use to check your net income summary. This is going to end up being $87,000. $87,000, which, if you remember, it's the same here as the $87,000 we had in net income. Same as the $87,000 we had in net income here. The balance in the income summary is going to equal your net income. All right. So then we're going to close that out to retained earnings. So that retained earnings is where we're going to retain our net income, our earnings. And then, so again, we have a credit balance of $87,000 in the income summary. We debit it to close that one out to retained earnings. Then we close out dividends to retained earnings, that $10,000 balance. We want that to be zero. So now at the end of the year, we have closed out all of our temporary accounts here. They're all closed out to zero, and retained earnings holds all of our net income and our minus our dividends declared for the year. It's all been updated for the next year. So going forward, the next year, we can start recording sales again, and it's going to record the sales and expenses for the new accounting period.